This is the macro show. This is pregame, okay? We're trying to play the game that's in front of us today. You know, leadership matters at Hedgeye. So again, being transparent, accountable, and trustworthy people. This is a game about playing and weighing probability. It's not about picking stocks. It's about picking the right portfolio.
First on oil, you get this real interesting setup. You're bullish from the medium-term trade perspective. So I wrote down 3 things that really are all I care about this morning. Bullish trade, bearish trend, top end of the range. So again, you can see where those things are. That's the best, really the best way to deal with this. Ironically enough, I had an institutional investor ask me last week. We did a whole bunch of calls, Steiner and I, and one was like, well, how do you deal with something like with a shock, from from OPEC or something? And I said, well, I really wouldn't, you could tell me that Frosty the Snowman told me not to buy oil, and I wouldn't care. It doesn't matter. All I care about are the 3 things that I just said. Where's the trade? Where's the trend? Where's the risk range? Make a good decision embedded therein. Obviously, this morning's not going to be good for any of our energy shorts. That said, we've covered a bunch of them, and it's a good spot to most likely take another shot on the short side. Don't forget that OPEC panicking is no different than bank bailouts or panic there. What's interesting is that in a 2-week period, Jonesy, we've had the Fed panic, the Treasury panic, OPEC panic, and they're all panicking, if you really think about it, about the same thing. Quad 4 demand, to your point. This would not be happening, obviously, if demand was accelerating. So again, you can see this if you listen to the call this morning. You're looking at the credit card data from Citigroup. You're looking at the credit card data more broadly. You're listening to any of our analysts from restaurants to Jay Van Sciver on Tesla, and Tesla pre-announced the same bunch of inventory, less demand. It's all there, and it's getting worse. So again, this harkens back to the end of the first quarter of 2001, of course, less so in 08, but both at the end of 01 and 08, the chartists thought that everything looked fine. This one in particular, you have 7 stocks that have equated to 90% of the return in the S&P 500, 7 of them. Obviously, that's why the Russell 2000 looks completely different than that.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.